Wise investing. How do economic cycles affect stocks and bonds? Imagine trying to navigate a river that constantly shifts with the tide. Sometimes the water flows fast and smooth, other times it slows or even pulls back. The economy moves in a similar way, going through cycles of growth and slowdown. These shifts impact how stocks and bonds perform, and understanding this can help us make wise choices with our money. When the economy is growing, companies usually earn more money and pay higher dividends. This often pushes stock prices upward because investors are optimistic about future profits. At the same time, central banks may raise interest rates to prevent inflation from getting out of control. Higher interest rates make new bonds more attractive because they offer better yields. As a result, existing bonds with lower rates tend to decrease in value. During these times, stocks tend to go up while bonds go down, showing a negative relationship. But when the economy slows down or enters a recession, things change. Stock prices often fall because companies earn less and investors become more cautious. During uncertain times, many investors seek safety in government bonds, which are considered less risky. As demand for these bonds increases, their prices rise, and interest rates tend to fall. This creates a situation where stocks decline while bonds rise, again showing a negative correlation. However, the relationship between stocks and bonds can shift if inflation becomes high and unpredictable. When inflation rises sharply, central banks may increase interest rates quickly to control it. This can cause both stocks and bonds to fall at the same time because higher interest rates hurt corporate profits and reduce bond prices. In these moments, stocks and bonds may move together, which is different from the usual pattern. From a biblical finance perspective, understanding these patterns reminds us to be good stewards of what God has entrusted to us. It encourages us to diversify our investments, holding both stocks and bonds, to manage risk over the long term. This approach aligns with biblical principles of patience, wise management, and trusting God's provision through all economic seasons. Practically, it means maintaining a balanced portfolio that can adapt to changes in the economy. During growth periods, stocks might perform better, but bonds can provide stability during downturns. If inflation is high, we might need to consider other strategies or assets to protect our resources. It also teaches us to stay calm and disciplined, avoiding emotional reactions when markets fluctuate. Instead, we can focus on long-term goals, trusting that God guides our steps and provides wisdom in managing our finances. Understanding how economic cycles influence stocks and bonds helps us become better stewards, balancing risk and reward to honor biblical teachings on money management.